So I'm going to have everyone introduce themselves. And as they introduce themselves, also want them to say what their favorite band of all time is. So we'll learn a little bit more about each of our panelists. And then we also want them to try to work in some music themes into their responses. So you guys can keep score on how they do on that, and we'll see how it goes. So with that, go ahead, Matt, if you want to kick it off for introductions.
Sure. Hello, everyone. I think there's pretty much all familiar faces in the room, but for those of you that don't know me, my name is Matt Demarco. I'm a vice president and account manager with PIMCO. I'll be celebrating my 15th year anniversary at PIMCO coming up here in 2 months, and I'm glad they're not showing my headshot because I feel like every time I come to an RPAG summit, it's a gentle reminder to get that headshot updated. But as far as my favorite band, right now I can confidently say that it's Pearl Jam. There's nothing better than sitting in the car, turning on channel 22 on Sirius Radio, listening to some live Pearl Jam, going out, get some Handel's ice cream. If Travis is in the room, he knows exactly what I'm talking about. But we're expecting our first baby here 1 month to the day, so maybe next year I'll say it's Coco Melon or Raffi, if Raffi still exists.
Thanks. Good afternoon, everybody. My name is Sam Mielnik. I'm an account manager, vice president with American Century Investments. I am a new face to all of you, so good to meet you all for the first time, many of you. I'm based here locally in Huntington Beach and cover the Southwest Territory. When I got the question about my favorite music band, I think it brought me back to some of my impressionable youth days, getting ready for either a high school or then eventually a college basketball game. And what got me pumped up before a game, and hands down, it had to be Black Sabbath for me. Ozzy Osbourne and sort of all the musical talent they had there really helped me set the mood and get fired up. Fired up enough I wanted to bite someone's head off. That's my Black Sabbath reference.
Hi, everybody. My name is Mark Feeney, Vice President, Defined Contribution with Alliance Bernstein. I'm based out of Denver, Colorado. A lot of you I know, a lot of you I haven't met yet, so I'm looking forward to hopefully meeting you over the next day and a half or so. And my favorite band musician of all time is Bruce Springsteen and the E Street Band.
All right, and the second Mark.
Mark Squared. Good afternoon, everyone. Mark Alteri with Capital Group American Funds. I'm a regional vice president, national account manager, covering RPAG, a select group of record keepers and insurers. It's a pleasure to be here with all of you. I've been with the firm for 9 years, 17 years in the industry. Looking at my favorite band, it got me thinking of the first CD I bought, and that would be the Dave Matthews Band CD.
All right, we've got some different music tastes up here. Well, thanks everybody for the introduction. And we want to go ahead and get started. One of the obviously big news items in the first quarter was what's going on with the banking sector. It really did feel like a little bit of another one bites the dust, starting with Silicon Valley Bank, Signature Bank, Credit Suisse, and thankfully, for the most part, it seems like it's contained. The reality is the banks are much better capitalized than they were during the great financial crisis, but still front of mind. So we wanted to start off with the panelists, and we're just going to walk the line on this. Just thoughts on the banking crisis and any meaningful exposure that you had in any of the CITs that we're going to be talking about today. Go ahead, Mark.
Sure. So I'm representing the Wilmington Trust Euro-Pacific Growth Trust Fund. This will be music to your ears. No regional bank exposure for that strategy as of 12/31 of 2022. When you look broadly at the Euro-Pacific Growth Trust, it's designed to serve as a diversified core international holding for a DC plan. What you will find, though, is we do have we do have financials exposure outside the U.S., so 11.8%. But again, no regional bank exposure.
So I'm here representing Small Cap Growth 2, which is managed by Alliance Bernstein, as well as Large Cap Growth 3. I'm fortunate enough as well to say that we did not have any exposure to any of the three names that Geoff mentioned. Being a growth manager, financials is not really a big part of what we do and where we allocate. But we had kind of the same sentiment that Geoff mentioned, that we think it was kind of contained and isolated to those three names that he mentioned.
Yeah, my comments are not too dissimilar from my previous two colleagues. We think some of the events around Silicon Valley Bank, Credit Suisse were very company specific. In terms of our strategies on the RPAG CIT menu, our large growth 4, mid-cap value, and small-cap value, we really didn't have any exposure to SVB, Signature, or Credit Suisse. But in our value strategies, mid-cap value and small-cap value, we do have exposure to regional banks and diversified banks, but that exposure is really just in line with our index, and that's actually an area that we really like right now and has been a positive contributor to performance there.
Perfect, and I'll echo all the comments just around broad speaking regional bank exposure. I'm representing PIMCO, RAE International, and RAE Small, so both of which are value strategies. We'll talk a little bit more about PIMCO's philosophy and process, but when it comes to regional bank exposure, if you look at the Russell 2000 index, they had about 17% exposure to regional banks. PIMCO, we look at a number of different factors when kind of narrowing down the investable universe. If we were just looking at price to book, we'd probably be in line with the Russell 2000 index, having around 17% exposure. Both RAE International and RAE Small had less than 1% exposure, or continue to have less than 1% exposure to regional banks, and none of which were the exposed banks. And we'll talk a little bit more about our process and philosophy in a little bit.
Great. Yeah, I mean, it seems like that's what we've heard from most folks is one, pretty well contained and not big exposure really across any of the CITs. So that was all good news. So another area, just shifting topics now to the international markets. It's really been sort of the last 10 years has been a long and winding road for this category where it's underperformed the U.S. markets pretty consistently. We did see a change though, last year, particularly in the fourth quarter, where we did see international outperform U.S. So I guess the question for you, Mark, starting with you, is there room to run in international markets, or should we stay or should we go with international?
Thanks for the question, Geoff.
Absolutely.
Finally, right? The non-U.S. markets finally outpaced. We saw this rebound in Q4 last year. This really came as we saw signs that inflation may be starting to moderate in the U.S. and Europe, and with that, it fueled expectations for a slower pace of tightening. When looking at the MSCI ACWI ex-US, we did broadly see every sector increase, and that was led by materials and also industrials. To answer the second part of your question, Geoff, we had a 10 investment themes webcast several weeks ago. I know that some of you may have joined that webcast, so I'll quickly describe a slide. And in this slide, what we did was we decomposed the returns of the MSCI regional indices. When you look at that, you'll of course see that the US had outperformed by far, averaging 12.5% annually. But when you look at the EPS multiples across the trailing 10 years, what you'll see is that the US traded at 19 times earnings. Looking at other regions, they're in that 12 to 14 times range. So when you look at that, along with the EPS compounded annual growth rates, there's a lot to be excited about outside the US. And really the bottom line here is our portfolio managers are not finding it difficult to find opportunities to invest client capital.
Great. All right, Matt, so I know PIMCO is also constructive on the international markets. What are the reasons that you see as an opportunity?
Yeah, I think Mark provided a good backdrop there. I guess before we think about looking forward, let's just take a step back and kind of look where we've been over the last 10 years. I mean, over the last 10 years, any sort of diversification really didn't work in your favor. It's really been a U.S. large cap, mega cap equity story, over the last 10 years, and we start to see that tide is starting to shift a little bit. We're also seeing a lot of recency bias within international and really U.S. equity markets over the last 10 years, really performance chasing, and oftentimes with that recency bias or performance chasing, it could take months or even years for that action to reverse course. So we think right now, if you just look back at the previous 10 years, so in the cycle looking at 2003 to 2013, you could almost tell the almost identical story of what we've seen over the last 10 years, but in reverse. International equities was the place to be. International equities outperformed. So we do think that there is some sort of cyclicality associated with this, and just over the last 20 years, it seems to be in this kind of 10-year buckets that's kind of leading into 2023. And in the fourth quarter of last year, we really saw the tide start to change a little bit. So, when you think about international equities versus US equities, I think you have to look at it in two different ways: performance and valuation. Talked about performance a little bit, the recency bias, but when you think about valuation, international equities has underperformed over the last 10 years. Today, if you look at the CAPE ratios, or the cyclically adjusted price to earnings ratio, which we think is a really good forward-looking indicator for future returns, US equity markets are trading at the top decile of performance over any given period of time in history. If you look back 1980, 1963, or Research Affiliates, who runs the RAE strategies, they actually look at this data going back to 1880. All of it stays the same. That right now, US equities are trading in the top decile of performance. On the other hand, international equities are trading in the bottom third in terms of their historical valuations. So we think that right now this is really an area of the tide to turn. And from a broader speaking basis, we think value, in addition to international, is going to be the place to be in the future. Just looking at what we think kind of the market outlook is, we think there's going to be a recession looming in the future. Value tends to outperform by the tune of around 10% in periods following a recessionary environment.
No, good insights, and certainly what we're seeing as well, certainly on the valuation side, when you look at international markets relative to the U.S., they're about one and a half standard deviations cheap when you look at PE or dividend yield. So there is certainly the value case to be made there. And then when you think about the other headwind that we've seen over the last 10 years for international markets, it's really been the U.S. dollar strengthening, and that creates a big headwind on returns for U.S. investors in international. That peaked last year and has been rolling over. That also coincides with the time where international started to outperform as the dollar peaked. So, you got a combination of maybe low valuations, higher dividend yields, with maybe improving dollar picture as well there. So, the other item we wanted to talk about was large cap growth, and this has been an exceptionally challenging category. Literally over 90% of active large cap growth managers have underperformed over the last 5 years. And a lot of that has to do with the concentration that we've seen in the market. Only a handful of names driving that Russell 1000 growth. We happen to have two large cap growth managers here, though, AB Large Cap Growth and American Century Ultra, that are actually in that 10% category, where they actually have outperformed the market over that time. So wanted to start with Sam and just talk about the sort of the challenges that have been going on in the category, and really how the team's been able to perform over the last 5 years.
Yeah, Geoff, you hit on it. The challenges within large cap growth space, especially managing against the Russell 1000 Growth Index, has been concentration risk, right? Over the last 5 years, we've seen something like 3/4 of the performance of that index being driven by the top 10 names alone. In fact, if you look at a year like 2021, where markets were on a tear, we saw a lot of the high-flying sectors really take off. Something like the top 5 names drove over 50% of the returns of that index. But sort of looking at that in a more historic context, the level of concentration that we see from the top 10 names in that index alone has doubled over the last 7 years. So it's definitely become a tougher environment for large cap growth managers to manage within that space. They want to produce risk-adjusted returns over that index over time, but it's becoming increasingly difficult to do so. There's certainly some names and sectors that you really can't avoid getting exposure to, but it's really how you can manage the portfolio outside of that and differentiate yourself within the category. I think every growth manager really defines how they express their views in the growth space slightly differently. At American Century, our approach is really taking a high-quality approach, looking for highly profitable, high growth rate companies that are able to do that over a long term and do it at scale as well. We think those are the type of companies that are going to tend to be rewarded in this type of market environment. And if we look at over the past 5 years, our portfolio, as you mentioned, has outperformed the Russell 1000 Growth Index in a positive way. That's a lot to do with our process of a high-quality bias, but also has to do with some of the firepower at the PM level, where our roots started with good, strong fundamental research and really good stock picking. That's where a lot of our alpha is generated from. And then maybe just to bring it back to SVB, for active managers, it's also important to understand company-specific factors that may attribute towards positive returns, but also understanding company-specific risks that you might want to avoid in the case of SVB or Credit Suisse.
Yep. Great. Yeah, no, it's certainly to outperform in that environment has been is impressive, and you've done it by a pretty wide margin relative to most large cap growth, even of the managers who've outperformed. So now, basically the same question for you, Mark. So AB, as of the end of last year, was ahead of the benchmark. Again, super challenging environment. So how was the team able to navigate that market?
Yeah, no, thanks, Geoff. So kind of echoing some of the things that Sam said, obviously U.S. growth struggled last year, or should I say growth stocks that were born in the USA?
We got one.
We're hit hard in 2022, with mega cap tech accounting for nearly half of that. So it was a really challenging year, obviously. FANG plus Microsoft accounted for, 36% of the Russell 1000 growth as of January of 22. And that went down to about 29% by the end of the year. So just a really, really tough year for growth equities, especially in large cap. We think that kind of echo what Sam said, is such high concentration risk. But when you kind of peel it back and you remove FANG plus Microsoft from the index, profitability actually still looks good. Growth is largely unchanged. We're not going to, at AB, at least in our strategy, we're not going to let the benchmark kind of dictate our weightings and what we put in our portfolio. We're looking for high quality growth companies at a reasonable price. So we're looking at stocks that have high return on invested capital, high return on assets, things like that really tilt them towards quality. And we really believe, I'm going to read it sounds corny, but we really do believe that you can create a diversified portfolio of attractive U.S. growth stocks without making sacrifices or concentrating too heavily in the largest names. This has helped us perform well because, per what Geoff said, we've performed really well the last few years. I know last year is not a year where we want to, beat our chest, but, the benchmark, the Russell 1000 growth was down 31%. We were down 28%. So I think it shows kind of what we do from a downside protection standpoint. And we would much rather outperform in a down market and lag in an up market if we had to choose between the two. So, and we also think it's a really good entry point for U.S. growth right now.
Yeah, and thinking about your performance in particular, not only through the end of 2022 was it ahead of the benchmark, but also did so with much lower standard deviation than the benchmark. So kudos to you on that performance. So I'm going to take it back to Sam now for a minute, and this is going to be a pretty broad question on what's American Century's outlook for 2023. But so Matt's already thrown down the gauntlet that they think value's the place to be. So you've got growth and value CITs with us. Where do you guys see the better opportunity?
Did you want me to talk about our outlook as well?
Yes.
Yeah. So our outlook on the market isn't probably very different from my colleagues up here, but we still think indicators are leaning more towards a recessionary type environment. Our probability is somewhere around 55+%. And then we're really trying to make a distinction of whether we're for like a hard landing or soft landing on the economy. But interestingly enough, despite our sort of more leaning towards recession, we see a reduction in stagflationary environment likelihood. That's been reduced, so we don't think we're heading straight towards an environment with low growth, high persistent inflation, and we actually are increasing the likelihood of some type of soft landing, Goldilocks scenario of high growth, moderate to low inflation, and a Fed that's either going to be on pause or provide more accommodative positions to further spur growth. In the case of like growth versus value, historically, I don't think there's really been any clear winner. I think in looking at the past 5 out of the past 8 recessionary environments, growth has been a clear leader over value. But when we look at downside metrics, value certainly has its own unique set of merits to use. So we're not going to make a distinction between the two. We think they both offer their unique merits and complementary characteristics to one another. Within our asset allocation funds, we are risk aware. We are leaning more towards the value and higher quality side of things. But we think this is definitely an environment where we could see both styles be rewarded.
Yep, got it. Makes sense. All right, so now back to Mark Feeney. So it's basically the same question for you on AB's outlook, and where are you currently seeing the best opportunities?
Yeah, so similar to what Sam said, I would say maybe we're a little bit more cautiously optimistic. The market would kind of tell you right now that they're predicting that the Fed will stop raising rates much sooner, given that the Russell 1000 growth's up 14% this year. So the market is telling us that, but there's still a lot of headwinds out there. Inflation's not nearly down far enough to where the Fed will probably stop. There's still geopolitical risk. I mean, there's still a war going on with Russia and Ukraine that's been largely ignored by the market. We probably have a pretty contentious election cycle coming up. So there's just a lot of things swirling that I think it make it tough to be optimistic right now. And growth estimates are much lower than before. But we're not, I guess, for both of our strategies, large cap growth 3, small cap growth 2, we're not trying to predict the market. We're not trying to predict what the Fed's going to do. We're going to stay in our lane and try and find high quality growth companies at a reasonable price. That's what we continue to do. And keep doing that until hopefully the market takes off again.
Got it. All right, so thanks for all that. A kind of good overview, top down, some good things that are going on out there. Now, last few questions, I want to drill down more into some of the specific strategies. So starting with Matt, so with PIMCO RA, we've got the international strategy as well as the recently launched small cap value strategy. So probably helpful just to start with an overview of the philosophy and process and how it's differentiated.
Yeah, so we just recently launched Small Cap Value 3. It went live January 3rd, so I know it's still getting up and running on many record-keeping platforms, but we're starting to see a lot of momentum there. What's good about research affiliates equity, and I guess here's my one Pearl Jam line is, and don't sue me, John, is it can't find a better fund. But and I say that from a compliance standpoint, I'm kidding. But what's good about international and small cap value when it comes to research affiliates equity is our process and philosophy is going to be the same for the entire suite of strategies, regardless of asset class. So all of them are going to have a value tilt to them, and what differentiates research affiliates process with the other value managers that are out there in this space? Well, most value managers are stock pickers. And research affiliates equity, what we're going to really do is our process is going to seek to have the same objectives as some of the best stock pickers that are out there in the value space today. So what those value managers are doing, if they're going to be looking at the fundamentals, they're going to be determining if the company is trading cheaply or not. From there, they'll take a view on quality. Oftentimes, cheap stocks that have low valuation characteristics tend to be value traps. So what they'll do is they'll take a look under the hood and determine the underlying quality of the actual company itself. And then from there, they'll look at the price action of the stock. They don't want to buy a stock that's in free fall or catch one of those falling knives. Research affiliates equity is essentially going to do all of this. We're going to do so in a systematic and unemotional way, an unemotional process. We'll have quarterly rebalancing, but we have a system in place to do so. So what we're going to do is we're going to do the same thing as traditional stock pickers. We're going to look at fundamentals. We're going to look at quality. We're going to look at price action. We're going to use our value and quality momentum tilts to determine what stocks to actually invest in. But what differentiates research affiliates equity? It's that we're going to use a holistic definition of value. Many of the other asset managers out there are going to look at one or two of these qualities, but we're going to look at actually a constellation of factors. So we're going to look at price to book, price to dividend, price to sales, price to cash flow, and then come up with about a 300 stock portfolio through the entire investable universe to invest with. A good example of kind of this in practice is what I kind of kicked off the meeting with in terms of our regional bank exposure. As I mentioned, Russell 2000 had about 17% regional bank exposure. If we were just looking at the price to book ratios, we'd probably be in line, if not slightly higher, but looking at all of those underlying factors that led us to have that less than 1% exposure across the board, international and small cap from our overall exposure because of our process and philosophy.
No, that's a helpful overview. And so when you think about, so it's literally the same exact process for international and small cap value, just different markets that they're investing in. So when you look at the alpha generation, small cap value has been exceptionally strong. And while international's been good around the benchmark, it hasn't been we haven't seen the same alpha generation as we've seen. So what are some reasons for the difference there?
Yeah, and I think a lot of it has to do with domestic versus international. If you just take a look at last year, or if you look at, let's even go back to 2020, so the last 2 years, one area of opportunity that we saw within our small cap value portfolio was small cap energy stocks. We saw value there, so we loaded up on buying them back in 2020, and that's been a great tailwind for us. If you think about the broad-based US equity markets over the last few years, cheap has outperformed expensive stocks. Your FANG and your mega cap stocks have underperformed, and your value stocks have outperformed. Now the same, or it's actually been the opposite in international equities or even in Europe. It's been an opposite story. Expensive has outperformed value. So while we have the same process and philosophy in place across research affiliates equity, just the different asset classes and sectors are going to behave differently. So over time, over a full market cycle, we believe and truly stand by our philosophy. It's just going to be dependent on what the international versus US equity markets are doing. Last year in US equities, cheap outperformed expensive. In Europe and international markets, expensive outperformed cheap. And you're starting to see that shift a little bit now. And we saw that in the fourth quarter of last year.
Yeah, no, that's helpful. And certainly what we've seen in the US markets, one of the things we look at is valuation spreads. When things get very wide, which we saw in the US, they compress and you get value really work well. We haven't seen that same compression in the international market. So to me, that's, if anything, just pent up opportunity in the international space. So thanks for that. It makes perfect sense. All right, so back to Mark Feeney. So AB small cap growth is our second small cap growth CIT. And it scores a 10. Long-term performance is phenomenal. However, 2022 was a very challenging market environment for the strategy. So I think it'd just be helpful for our advisors to get some talking points on what happened with 2022 underperformance and how the team is positioned.
Yep. Geoff said it. I mean, 2022 was a really tough year, specifically for small cap growth as a category, and relative for our fund to its peers. We struggled last year. Small cap growth as a whole is much more sensitive in a rising rate environment. Much more speculative, highly leveraged names, less profitability. So when the cost of capital goes up, they're going to struggle. What we saw from our peers, I think, that made our relative peer group numbers look worse. We saw a lot of our peers, our competitors, tilt more towards the middle, and those are the funds that kind of outperformed in 2022 from a peer group ranking standpoint. The ones that tilted more towards core and value and kind of just timed it right. We don't do that. We're a style peer growth manager for small caps. We're not going to try and cheat one way or the other when we think the market's right. We think you're going to be wrong more often than not. All that being said, it was still a pretty difficult year. But I think the good news is coming out of these recessionary periods and down market years, AB small cap growth and small cap growth as a category have outperformed considerably. I mean, think coming out of 2000, 2002, 2008, 2018, small cap growth really led the pack coming out of those years, and AB small cap growth outperformed considerably in those years. And we're hopeful that 2023 remains the same. So far year to date, we're up over 200 basis points over the benchmark. So we've had a strong start to 2023, top decile performance. So we're hopeful that keeps up. And we're hopeful that eventually the Fed takes the shackles off, because small cap growth stocks were born to run.
There we go. All right. I think you're in the lead now. You've got two, so good work. All right. So no, that's helpful. And certainly, when you think about, when we're selecting these managers, we always think about, well, what environments would we expect a strategy to perform well or not? And the 2022 was like a perfect example of where we would expect that you would trail in that environment, where it was really the higher growing, faster, higher multiple, faster growing stocks that suffered the most in that environment. Same as what we saw in 2016. It's kind of a mirror, it's a very similar time frame. You guys underperformed in 16 and then came ripping back. In fact, we had Samantha Lau in our office, the lead PM on the strategy, and we were talking about it. And told her that exact thing, that, yeah, it was a tough year. We get it. If you would have outperformed in that environment, we would have been more concerned because you're not following your process. So, but again, still long-term performance phenomenal. And actually, we're seeing a nice already start to the year for the strategy. So coming back strong already. So thanks for some of those talking points. All right, and then back to Mark Alteri. So speaking of holding up well, so Wilmington Trust American Funds Target Date Series did hold up exceptionally well last year. And some of that has to do with what was going on in the bond market. But so maybe if you could just provide an overview of the differences between the Wilmington Trust American Funds TDFs and the standard American Funds TDFs, and maybe why we saw the Wilmington Trust strategy hold up very well last year.
Sure, glad to share. Thanks for the question, Jeff. We were really pleased to see the calendar year 2022 investment results. When looking at our off-the-shelf target date fund series, the American Funds Target Date Retirement Series, our glide path is thoughtfully designed to both build and preserve wealth. The Wilmington Trust Series seeks to emulate the glide path, so the equity and the fixed income are nearly identical, but there are some key differences to note. To make sure I capture them all, on the equity side, the strategists seek to allocate the funds in nearly identical allocations, except for the balanced fund, and 1/3 of the balanced fund is allocated to the fixed account. Switching gears, moving over to the fixed income side. On the fixed income side, most of the fixed income weight is allocated to the Great West Guaranteed Funding Account. Now, this does cap out at 49.4%. You will also see our high yield fund, the American High Income Trust Fund. It is in select vintages. There's 3 in that transition phase. And then finally, when looking at select vintages moving 10 years past the retirement date, you will start to see our fixed income funds you'll see them reappear as partial weights relative to our off-the-shelf series. Now, many of you may find this interesting. When looking at this series, the first plan to fund it was a $100 million plan. Now, I know in the marketplace, some may consider this solution small market, but I think we can all agree that people are looking for a quality QDIA solution with potential lower pricing. And I also like to always make sure that folks consult with their local Empower contact, because plans that utilize the Wilmington Trust American Funds Target Date Series may qualify for a pricing conversion credit.
Excellent. Yeah, so certainly a part of the guaranteed component, an environment we saw last year with rates rising dramatically just served as a great ballast to ideally get those fixed returns over time with less volatility, and that's certainly what we saw come to fruition last year. So thanks for all that. So we do have a few minutes left, and one of the things we did talk about is just to hear from each panelist, and we'll just go down the line and kind of the last thoughts that you want to leave with the audience today. So I'll start with you, Matt.
Yeah, I guess just my last thoughts. I talk to a lot of you on a frequent basis, both on the RPAG, the NFP, and the FlexPass side. I just want to say thank you. We launched RAE International in the midst of the COVID pandemic, where we weren't really out there doing hand-to-hand combat. We launched at about $100 million from the takeover from the existing strategy. Today, we're just under $500 million. So there's been just a ton of momentum there, and we look to continue to grow that. Same thing with RAE Small. We just launched in January. We're still very limited in terms of record keeper availability, but to date, we've raised over $25 million since January 3rd. And I know we talked a lot about alpha generation, conceptually, how these funds have performed, alpha, versus asset class, but I will say for RAE International, while the category itself has underperformed small cap value, The RAE International strategy, going back to its inception, if you look at any rolling 5-year period of time, it's outperformed its benchmark 100% of the time. And then the same thing for small cap value. It's any rolling 5-year period you look at since the fund's inception, it's outperformed its benchmark 98% of the time on any rolling 5-year period. So, the philosophy and how we've prioritized the stock selection within RAE Small and International, it's working. And thank you for all of your continued partnership, and we look forward to building this out even further.
Yeah, thanks. My final thoughts, I guess, would be to just sort of take a historical context of where we've been and recognize that markets are going to be different going forward. Certainly over the last 12, 14 years, the markets have been on a crazy train. That's one. But with high interest rates, high inflation entering the market, certainly investors are getting a little bit paranoid. That's my second.
I think he just pulled into the lead.
Yeah. But I think what's important, and something Matt alluded to earlier, is that for a long time, active management has really been out of favor. We saw that last year with sort of the historic negative stock-bond correlation being flipped on its head. But I think what now we're seeing, and a lot of what my colleagues here talked about, was where the value of active management can really show some merits for clients. One portfolio we didn't talk about was our mid-cap value strategy. That's also on the CIT menu. Last year, great performance, really showing what our calling card is, which is downside protection, high quality focus. We outperformed our index by almost 11% or 1,000 basis points in that type of market environment. But I guess my final thought will be that with sort of volatility normalizing, that we're entering an environment where there's a premium on portfolio protection and active management, and we appreciate your partnership.
Excellent. And then I did mean to touch on mid-cap value strategy a little bit more, and that was great. Again, a lot of the theme we're hearing today was holding up in down markets, which is so important, certainly in the retirement world. So, but maybe just take one more minute to share what is it about that process that leads to that great downside protection?
Yeah, it's really just that, just taking a really heavy quality first focus within the value space. But for more historic context, we look at a year like 2021 where we saw a lot of high flyers, a lot of those like growthy, cyclical type names really take off. We actually lagged the index slightly. But then we look at a year like 2022 where sort of flipped on reverse. We saw a lot of negative performance driven by some of those same names, where we were able to really separate ourselves by being more positioned towards high quality names. A lot of names we owned were flat to slightly down, so we were, again, in that environment, able to outperform by almost 11%.
Yep. Great.
I just wanted to say thank you for the partnership. We really appreciate the partnership with RPAG, all that you do, the advisors out there that have met with me out in the field, that have supported our products that are on the RPAG platform. We really appreciate it. We think it's a good entry point for growth potentially. With the way the market's been this year, it's been a little topsy-turvy. I think it probably will be moving forward, but it could be a good time to dip your toes in growth, as premiums on growth stocks have come down quite a bit. So I think it could be a time, but again, just really appreciate the partnership and being here.
Great. All right, Mark.
I'll close with a thank you. We truly appreciate the partnership with all of you in this noble quest of helping participants retire with dignity. With that said, I will close with a final thought on Euro-Pacific Growth Fund and the importance of a long-term perspective. We always like to look at rolling 10-year timeframes. That way you have a meaningful time frame. When looking at the fund itself, through a rolling 10-year period, the fund trailed its benchmark only 2% of the time. In subsequent 10-year rolling periods, on average, the fund has produced a 100% success rate, and the average excess return is over 480 basis points. So again, the importance of a long-term perspective.
Excellent, wise words to end with there on that long-term perspective. Certainly always pays off in investing to look out. So thank you all very much for your time today, and let's give our panelists a big hand. Thank you, guys.